Have you ever felt the sting of missed opportunities? That gut-wrenching feeling when you see a stock skyrocket, knowing you could have been on board. It's a pain many investors know all too well. But what if I told you there's a way to not only avoid that pain, but to actively capitalize on undervalued gems, the kind that can genuinely double your money? We're diving deep into the world of Warren Buffett, the Oracle of Omaha himself. He didn't build his empire on luck. He built it on a profound understanding of value investing, a strategy that isn't about chasing the next hot trend, but about patiently identifying companies trading significantly below their intrinsic worth. Think of it like finding a rare, uncut diamond buried amongst common stones. Buffett famously used the cigar butt analogy to describe this strategy. He'd pick up a discarded cigar butt, even if only one puff remained, because that single puff is still valuable. It's about finding those small, seemingly insignificant opportunities that, when combined with patience and shrewd analysis, can yield extraordinary returns. Today, we're uncovering 3 undervalued stocks that, based on publicly available data, align perfectly with Buffett's investing philosophy. These aren't speculative baits. These are companies with solid fundamentals, resilient business models, and substantial growth potential, still trading at what we believe to be a significant discount to their true worth. But let's be clear, even with the wisdom of Warren Buffett guiding our search, every investment carries risk. We'll explore each company in detail, examining their financial statements, competitive landscapes, and management teams. Thorough due diligence isn't optional. It's the cornerstone of intelligent investing. It's about understanding the why behind each decision, not just blindly following the crowd or a famous name. Are you ready to unearth these hidden treasures? Let's begin. Let's address the elephant in the room. The allure of following Warren Buffett. It's tempting, isn't it, to simply mirror his investments and expect similar results. But this is where the pitfalls of herding behavior lie. We're all susceptible to following the crowd, especially when the crowd includes one of the most successful investors in history. This is where our own cognitive biases sneak in. Confirmation bias, for example, might lead us to selectively seek out information confirming our belief that Buffett's picks will always succeed. The availability heuristic makes recent successes highly visible, potentially blinding us to the risks involved. Remember, past performance is not indicative of future results. Buffett's success stems from his unwavering commitment to long-term value investing, a strategy that demands patience, discipline, and a deep understanding of fundamental analysis. This is a stark contrast to more speculative approaches that prioritize short-term gains. While he may occasionally make headlines with bold moves, his core philosophy remains consistently focused on identifying undervalued companies with strong competitive advantages. So, how do we avoid the trap of simply mimicking Buffett? By doing our own homework. This means delving into the financial statements, understanding the company's business model, evaluating its management team, and assessing its competitive landscape. It means looking beyond the headlines and forming our own informed opinions. Ultimately, successful investing isn't about blindly following others. It's about developing a personalized strategy aligned with your own risk tolerance and financial goals. It's about understanding the nuances of your own psychological landscape, recognizing your biases, and constantly learning and adapting. This isn't about luck, it's about informed decision-making. And that starts with independent thought and rigorous analysis. Let's move beyond the surface-level hype and delve into the specifics of what makes these 3 stocks potentially compelling investments. We'll be examining key financial metrics, think price-to-earnings ratios, debt-to-equity ratios, and return on equity to get a clearer picture of their intrinsic value. It's about understanding the numbers, not just the headlines. Beyond the numbers, we need to understand the competitive landscape. What are these companies' economic moats? What protects them from competition? What's their potential for long-term growth? These are critical questions that determine whether a company is truly undervalued or merely a fleeting opportunity. Remember, we're not operating in a vacuum. Macroeconomic factors like interest rates, inflation, and geopolitical events can significantly impact the performance of any stock. We need to consider the broader economic context and how these factors might influence the trajectory of these specific companies. Building a diversified portfolio is essential. These 3 stocks, while promising, shouldn't represent your entire investment strategy. We'll explore how to incorporate them into a broader, well-diversified portfolio that effectively manages risk, aligning with your personal financial goals and risk tolerance. Finally, investing isn't a set-it-and-forget-it proposition. Regular monitoring is key. We need a framework for tracking the performance of these stocks, analyzing new data, and adapting our strategy as market conditions evolve. It's an ongoing process of learning, adapting, and refining our approach based on real-time information. Investing isn't just about numbers, it's deeply intertwined with our emotions. Fear, greed, and regret. These powerful forces can significantly distort our judgment, leading to impulsive decisions and missed opportunities. Understanding this emotional landscape is as critical crucial as understanding financial statements. Cognitive biases further complicate matters. Anchoring bias, for instance, can make us overly attached to initial price points, preventing us from objectively assessing a stock's true value. Loss aversion, the tendency to feel the pain of a loss more acutely than the pleasure of an equivalent gain, can lead to premature selling and missed potential profits. How do we navigate this emotional minefield? A well-defined, long-term investment plan is your compass. Sticking to this plan, especially during market volatility, requires discipline and self-awareness. It's about having a strategy and trusting the process. Improving self-awareness is a continuous journey. Recognizing your emotional triggers, understanding your personal biases, and developing strategies for managing your reactions are all essential steps. Journaling your investment decisions and reflecting on your emotional responses can be incredibly powerful tools for self-improvement. Finally, remember that seeking professional advice isn't a sign of weakness, it's a sign of wisdom. A financial advisor can provide objective perspectives, help you manage your emotions, and ensure your investment strategy aligns with your overall financial goals. Emotional intelligence, in the end, is just as valuable as financial literacy. The magic of compounding is often overlooked, yet it's the silent engine driving long-term wealth creation. It's the snowball effect, where your earnings generate more earnings, accelerating your growth exponentially over time. Think of it as a virtuous cycle, where success breeds further success. Imagine investing a small amount consistently, year after year. The initial returns might seem modest, but as time passes and your investment grows, those returns compound, creating a powerful snowball effect. A simple illustration: a modest annual return of 10% might seem unimpressive initially, but over decades, it can transform a small investment into a substantial sum. Understanding your compound annual growth rate (CAGR) is crucial. This metric provides a clear picture of your average annual return over a specific period. Calculating your CAGR allows you to assess the effectiveness of your investment strategy and compare it against market benchmarks. Staying disciplined is vital for harnessing the power of compounding. Avoid impulsive decisions driven by market fluctuations. Resist the urge to chase quick gains or panic sell during market downturns. A long-term perspective is paramount. Remember, compounding works best over extended periods. Patience is the ultimate virtue in investing. While short-term market volatility might be unsettling, it's crucial to maintain a long-term focus. The potential rewards of compounding over decades significantly outweigh the anxieties of short-term fluctuations. It's a marathon, not a sprint. Investing inherently involves risk, and understanding how to manage that risk is paramount to long-term success. Diversification is your first line of defense. Don't put all your eggs in one basket. Spreading your investments across different asset classes, sectors, and geographies helps mitigate the impact of any single investment underperforming. Knowing your risk tolerance is crucial. Are you a conservative investor comfortable with modest returns and minimal risk, or are you more aggressive, willing to accept higher risk for potentially greater rewards? Understanding your personal risk profile is fundamental to building a suitable portfolio. Managing risk actively requires strategies like stop-loss orders, which automatically sell a stock when it reaches a predetermined price, limiting potential losses. Hedging techniques, while more complex, can also help protect your portfolio from market downturns. These are tools to consider, but always remember that no strategy eliminates risk entirely. Keeping a close eye on overall market conditions is vital. Economic indicators, geopolitical events, and shifts in investor sentiment can all impact your portfolio. Adapting your strategy based on these changes is a sign of a proactive and informed investor. Flexibility is key in navigating complex risk situations. Professional financial advice can be invaluable. A qualified advisor can offer objective insights, help you assess your risk tolerance, and develop a robust risk management strategy tailored to your specific circumstances. Remember, seeking help is a sign of strength, not weakness. We've explored the world of undervalued stocks, following the trail blazed by Warren Buffett. But remember, this journey isn't about blindly following anyone. It's about empowering yourself with knowledge and building your own path to financial freedom. The key takeaways are clear. Value investing, grounded in thorough due diligence and a deep understanding of a company's fundamentals, is a powerful strategy. However, this strategy must be combined with robust risk management, diversification, and a keen awareness of your own emotional biases. Investing is a marathon, not a sprint, requiring patience and discipline to reap the rewards of compounding. Don't just passively accept investment advice. Actively engage in independent research, scrutinize financial statements, understand competitive landscapes, and form your own informed opinions. Develop a personalized investment strategy that aligns with your unique goals and risk tolerance. There's no one-size-fits-all approach to financial success. Your journey to financial mastery is a lifelong pursuit. Continue learning, explore additional generational resources, and never stop questioning conventional wisdom. Embrace the power of compounding, the magic of patience, and the importance of emotional intelligence in your investment strategy. The path to financial freedom is paved with informed decisions, diligent research, and a commitment to long-term growth. It's a journey of continuous learning, adaptation, and unwavering self-belief. What steps will you take today to build your own future?